Inflation coming in hot, but the core a little bit lighter. 30 minutes until the start of trading. I'm Matt Miller. Dani Berger is on assignment. Bloomberg open interest starts right now. Coming up, a tame inflation report helping calm markets this morning with stocks clawing back earlier losses. Meanwhile, President Trump warns Iran will pay a price for taking too long to negotiate a peace deal, and SpaceX fever is going global with institutional investors and sovereign wealth funds, including from the Middle East, piling into this record-breaking IPO. In terms of the stocks that we're watching this morning, NVIDIA right now down 1.7% in the pre-market. So you can see tech as well as travel, American Airlines down, and mining stocks down. Anything linked to inflation hedges like gold, for example, falling after the latest CPI print and President Trump's threats to resume strikes on Iran. Inflation, as I said, accelerated as expected in May, with the consumer price index climbing by the most since 2023. So 4.2% was the headline number, but the core number, especially month over month, was light at 0.2%. Let's break it down with Michael McKee, Bloomberg's international economics and policy correspondent, here at the desk with me. So, Mike, I guess it's the month over month number that investors are paying attention to here.
Probably, and maybe the composition of what happened. We did see CPI on a year-over-year basis up 4.2%, 4.249 if you round it out to 3 decimal places to see what's going on. And the trend is obviously not your friend. But there's some interesting numbers under the hood. As you mentioned, core up just 0.2 during the month, does push the year-over-year to 2.9%. But beyond energy, the composition of what we see in terms of inflation has changed a little bit. Gasoline prices up 7%. Don't have to tell you about that. Airline fares 2.7%. That's also fuel. But core goods prices down 0.1%. And you look at what the Fed has been saying. They've been expecting tariff price increases to sort of fall out of the CPI calculation, and that seems to be what's starting to happen. Also, motor vehicle insurance, that's one that moves a lot around, and it has been falling now, 1.7%. And food at home, it was up 0.7 last month, and that was considered a real warning sign for the president because, of course, everybody hates inflation and goes to the grocery store all the time, but it rose only 0.1%. Now, overall, what we're seeing is rising inflation. But if we are seeing some decline in tariff-related indexes, then what we might see is the PCE numbers, the Fed's most important forecast, coming down a little bit, and that would be helpful. A couple of things where prices moved a lot. Well, be helpful to the folks at 1600 Pennsylvania Avenue.
Kevin Warsh.
But I wanted to mention a couple of things that moved. One of the things that pushed up inflation this month in services was tax preparation. Of course, you got to pay the tax guy, the accountant, when you file your taxes, up 11.8%. And Matt, did you buy your World Cup tickets?
No. You know why? Because soccer is a dead, boring game.
Now, I've just put you out on a limb that the guy sitting next to you is going to argue with you about. But the point being is admission to sporting events had gone down for the last several months, and now they're up 2.8%. That's a World Cup effect.
All right, Michael McKee, thanks very much with a look at inflation. Let's get to the latest on SpaceX. Shares are said to be multiple times oversubscribed ahead of the biggest IPO in history, including billions of dollars in orders from Middle East sovereign wealth funds. Let's dig into this with soccer fan, Bloomberg Tech co-host Ed Ludlow. Ed, no offense on the soccer, the soccer thing. Let's talk SpaceX first. Massive oversubscription here, as expected.
There's always like a pause, though, where you're like, remember, that's part of the deal. That's part of the game the bankers are playing in a mechanism like this. But state of play is very simple. Multiple times oversubscribed. There's about $250 billion worth of orders, and they're going to raise $75 billion as it stands. Saudi Public Investment Fund, the Kuwaitis have placed an order per our reporting. And then there's this like group of long-only asset managers institutionals that we understand, some of them have placed an order for $10 billion worth of shares in a block. Whether they get them or not, like, we'll find out. But the institutional book closes at 4 p.m. I find it super interesting because, like, SpaceX is technically in the middle of or at the end of a roadshow. But it's because they priced, and we reported that they priced $135 a share up front. It was kind of like, well, what's the point of the roadshow? And in the reporting, we detailed that actually orders have increased between Monday to Tuesday, then Tuesday to Wednesday. So it's worked, right? The bankers have done their job.
But it's all based on the dream, right? It's all based on Elon Musk was with JP Morgan and Jamie Dimon investors. Basically pitching the dream, didn't really want to talk about the hard numbers or the near-term forecasts, right?
So to Jamie Dimon's credit, though, he was like, in the end, he was like, but I'm going to ask the same question again. It's why are you IPOing? And Elon Musk was like, oh, because we need money for growth. It goes back to the original story, which we broke, right? I remember breaking this story. SpaceX is going to IPO to raise a lot of money to buy GPUs spit in space. And at the time, people basically laughed at us and were like, no, that's exactly what's happened. And so materially in the background, without making this just like us patting ourselves on the back, since Sunday night through this morning, part of what the bankers have been trying to pitch to the big anchor investors and the institutions is the orbital data center story. And you'll see various media outlets have reported that SpaceX is briefing that they might pull forward the timeline on that. So in the prospectus, they said 2028 is when into 29 is when you might first see a data center in space. They're now saying they'll aim for demos in 27. You know, this is all part of the process.
I mean, all credit to you and to Elon Musk. At the time, it was impossible to believe. And now, like so many other things, it's becoming assumed that that will turn to reality. I want to point out that we're just getting headlines across the terminal right now. Senator Elizabeth Warren calling on the SEC to delay the SpaceX IPO. She's calling for a review of the IPO, so we'll continue to watch this story. It's also not something that's terribly unexpected, is it, from Senator Warren. Ed Ludlow, co-host of Bloomberg Tech, here in New York for this historic IPO. Now, part of what's happening around this and other giant IPOs that we're expecting this year is that investors are trying to free up cash and selling other stocks. But Wall Street is also digesting the latest inflation print. So we're looking at kind of an up and down trade here, as well as a situation in Iran that could be good, could be bad, or could be just the same as it is. Joining us now is Morgan Stanley Chief U.S. Equity Strategist and Chief Investment Officer Mike Wilson. Mike, even if we claw back some of the losses today, we're still seeing this rotation. It looks like maybe out of tech into something else, or maybe it's investors freeing up cash for big IPOs. How do you explain the drops that we've seen today, yesterday, and especially on Friday?
Yeah, I mean, I think so. First of all, we've had this concentrated market in the last month, and it's part of this rotation that's been going on all year from one cyclical group to the next. And I would actually say it's from one commodity to the next. Okay, we can go through that in a minute. And so now, what happened last week, and we wrote about this week in pretty good detail, is that the earnings revisions that we've been probably the most bullish on, I think, than anybody this year, have even exceeded our expectations. And they've gotten to a point now where the revision breadth, the leading indicator, second derivative, is now at a level that's unsustainably high. Okay. So I'll give you an example. Semiconductor revision breadth got to 70%. That's only happened 3 or 4 times in the last 25 years. The S&P 500 revision breadth is close to 30%, also very, very high. So it's going to roll over. Now, last week we had a couple companies report in the semiconductor industry. They were fine, but the revision breadth started to roll over. So it's a second derivative, and then there's leverage in the system in that trade, and that's sort of starting to unwind a bit. To me, there's going to be a transition now to some new leadership.
All right. Maybe it's a little too much math for my brain, but I was looking at earnings revisions, and since last time you were on, you pointed out they were pretty much convex, right? I mean, just continued to climb. We have a chart of that. We'll probably pull it up in a second. It looks like we're getting near a plateau, at least for 2026 earnings revisions, which I guess makes sense. What do you make of that? You know, how much longer can we continue to head upwards with earnings revisions, and what do you mean by revisions breadth?
Yeah, so revision breadth is just the breadth of the revisions as opposed to the absolute level, and it leads the second derivative, the rate of change on the actual growth. So I do not expect the first derivative, i.e. the forward earnings growth, to come down or fall.
We're showing it here in white 2026, in blue 2027.
Right, so that white line is going to continue to go, but the revision breadth is rolling over. So that there's a deceleration, a second derivative, okay, which is what the market's picking up a little bit. That's a correction. That's not a change in the trajectory. So as we go forward into next year, that NTM, forward earnings, is going to continue to rise. And that's our call. That's why stocks can continue to rise into year end. Multiples don't have to rise. It's just a forward, you move forward into 2027 as you look forward for 12 months. But the rate of change matters. In the short term, it matters. And that's what's going on right now. That to me, that's going to lead to some leadership change, just like it did earlier in the year when we went from gold and silver stocks to metals to energy, and then we went into DRAM and semiconductors. By the way, all four of those are commodities.
I see. Yeah, because you said earlier we're going from one commodity to the next.
That's right.
But semiconductors, DRAM, high bandwidth DRAM is the hot commodity of the moment,
That's right?
Are we going to shift out of that into something else?
Well, it's happening. I mean, Friday's sell-off is a sign that that's exhausted. And we did a chart this week. It was pretty interesting. We looked at silver stocks versus semiconductor stocks, and it's like right on top of each other. And we made this call at the end of January. We said gold's probably going to go down 30%, and that would be normal. That's what I would like to see, because you can't stay at that pace. To your point, you can't stay at that rate of change,
right,
both on price of stocks or the revisions. The key is there a place to rotate to that the market can kind of hold in? We think there is, and we've highlighted that as consumer, some of the other industrial areas like transportation stocks, and even the regional banks. And by the way, all three of those areas were up yesterday in a down tape.
All right, Mike, we're going to keep you with us. We're fortunate enough to have some time with Morgan Stanley's Mike Wilson today. Let's check on what's going on with markets as we approach the opening bell. Just about 19 minutes to go. We're looking at S&P futures that are now down about 0.5, about 0.5% right now in the S&P. NASDAQ futures down about 0.8%. You can see the 10-year yield is little changed at 4.52, 4.53, and Brent crude, which had been falling, is now rising, but only $1.08 to 92.53. So to a relatively low level. Let's get a look at some of the single stock stories we're following for you this morning. Energy stocks are climbing with oil after that turned around as President Trump says Iran is taking too long to negotiate. He threatens more attacks, so either all-out war is coming or they'll sign a deal within minutes. Supermicro is raising $7 billion through equity offerings to fill $39 billion in AI server orders from customers. That stock reacting very negatively, getting more than decimated, but of course it's incredibly volatile, SMCI. Delivery stocks like Old Dominion and FedEx are plunging after Amazon expanded its LTL freight offering to all destinations in the U.S. So when Amazon moves into a market like that, investors take note. You can see FedEx Freight Holdings down 5%. Coming up, President Trump warns Iran it will have to pay the price for taking too long to negotiate a peace deal in negotiations that he says are going very well. This is Bloomberg Open Interest. Let's get now to high interest and look at what's making headlines around the world. Softbank's talks with potential creditors to raise $6 billion from a margin loan backed by its OpenAI stake have stalled. Sources tell Bloomberg the company is considering various other fundraising options and could still move forward with the loan at a later stage, but it comes after the firm cut its initial target from $10 billion already. Progressive Democrat Graham Platner won the party's Senate primary in Maine with about 72% of the votes. Platner's campaign was marred by accusations of past misbehavior, including disturbing behavior towards ex-girlfriends or allegations of that, which he has denied. The November race is considered one of the Democrats' best shots at securing a Senate majority. And President Trump says Iran would have to pay a price for taking too long to negotiate a peace deal. The U.S. and Iran exchanged strikes overnight after the president blamed Tehran for downing an American Apache helicopter. U.S. fighter jets hit Iranian air defenses, radar sites, and ground control stations near the Strait of Hormuz. And joining us now to talk more about this is Bloomberg Washington correspondent Tyler Kendall. Tyler, it seems the president says he could escalate the conflict, but at the same time that he has high confidence or faith in negotiations that are going well.
Right, Matt, at this point, it's not immediately clear if President Trump is prepared to end the ceasefire agreement that has been in place, but also saw the worst flare-up in fighting this past week after the truce was announced back in April. At this point, this latest renewed threat from President Trump is really underscoring what has been ongoing frustration from this White House, which has repeatedly maintained that they are prioritizing diplomacy to end this conflict. But at this point, we don't know what's going to happen next year. A person familiar with the matter did tell Bloomberg News overnight that the negotiations are ongoing and that they are intense, being mediated by Pakistan. But now we have this risk that we could see further kinetic action after, as you mentioned, we saw both the U.S. and Iran exchange strikes overnight. CENTCOM confirmed that it acted in what it called a self-defense and proportionate manner after we saw this American military helicopter shot down the other day. Our own analysts at Bloomberg Economics say that this escalation in tension could mean a few different things, but their assessment is that this may be a bid to escalate in order to de-escalate, and that neither side seems to be too keen on trying to get back to high-intensity warfare. Matt, we did get a little bit more of an insight into where these negotiations may be headed. There was this New York Times report yesterday that appeared to suggest the two sides are making some progress towards the issues related to Iran's nuclear program. That includes discussions around a potential lengthy moratorium on uranium enrichment, which, according to the Times reporting, has U.S. officials thinking that that ban may last up to 15 years.
Tyler, just quickly, what do we know in terms of specifics about the Apache that was shot down, the pilots and crew that were on board, and who's responsible for it?
That's one of the big questions. We are waiting for a finalized report to be released. We did hear from Iran's foreign minister in a post on X yesterday, who didn't deny that Iranian forces were involved in the downing of this American military helicopter, but seemed to suggest that it wasn't done on purpose. That has raised questions on exactly how this attack happened. We do know, of course, thankfully, that both of those two American service members are safe and that they were rescued in what is considered a first-of-its-kind mission using U.S. drone technology. President Trump was pushed over the weekend in an interview with NBC News on what his red lines would be in order for a ceasefire to end. He said if American service members were killed or if he believes that there isn't the potential to make a deal. And those are really the threads that we're watching for this morning as we wait to see what the U.S.'s next action will be.
Is there a drum major near you? Is that a marching band?
It's actually the National Park Service, which spends a lot of time here making sure that the White House looks nice and pretty.
Good, excellent. Tyler, thank you very much for that. Bloomberg's Tyler Kendall reporting live from the White House. Let's bring back Morgan Stanley Chief U.S. Equity Strategist and Chief Investment Officer Mike Wilson. First off, Mike, how much does this really move markets anymore? I mean, we're kind of used to no outcome here.
That's right. We've likened this to the tariffs a year ago. We were probably the first ones to sort of not dismiss what's going on in the Middle East, of course, but that the market has moved past the oil spike like it did with tariffs. So if you go back a year ago in June, people were still kind of hand-wringing around the tariffs, like, because we didn't take them down, but the market moved past it, and it started thinking forward, and it started focusing on the earnings revisions, which were turning positive at the time. And I think it's a very good analogy. Nobody really knows how this is going to work out. But what I like to say is that the world is a lot more resilient than people think around these types of activities. And you know, we've had obviously some facilities get destroyed in this, particularly in Qatar. And I like to remind folks that, you know, when Russia invaded Ukraine, we saw the Nord Stream pipeline get blown up. And people are like, oh my God, this is, and what happened? Germany built a bunch of LNG facilities because the world is resilient, like it won't tolerate this. And I also think that ultimately, Iran is fighting not just the United States and Israel on this, they're now fighting the world, right? So the pressure is going to build here. And ultimately, like my base case is that enough flow is getting through now, and there will be new flow, and then there'll be new supply, as we were talking offline. I think this is going to lead to basically many countries basically adopting, kind of going back to fossil fuels.
And new routes as well. I mean, it's interesting
right.
to me that after, a U.S. helicopter is shot down, you have to assume by the Iranians, and then the U.S. launches a counterstrike, we're still seeing Brent at $92 a barrel and WTI under 90. It's like, all the horror stories we have about inventories being dry aren't moving this market.
That's right. Well, we're not there yet, right? I mean, and markets, they wait until the last minute because we don't know the answer. It's a binary outcome. Now, what would make me bearish is if the kinetic war really escalated again. Like if we went back to where it was in the first couple of days of this conflict, that's a situation that I'm not planning on. If that were to happen, yeah, oil's going to probably spike to 150 pretty quick, and we're going to have a real problem. But I mean, that's not my base case.
All right, we are fortunate enough to have more time with you, so we're going to keep you with us. Mike Wilson from Morgan Stanley staying through the market open. Reminder, he still does have that 8,000 target on the S&P 500 at year-end. Coming up in the next hour, more on markets and inflation and the economy with RBC strategist Lori Calvasina. She joins us at the top of the hour. This is Bloomberg Open Interest. Get a look at some of our other movers, the movers on our radar this morning. Freight stocks like Old Dominion and FedEx are plunging after Amazon's expanded its LTL freight offering to all destinations in the U.S. You can see Old Dominion freight line down more than 7%. Chewy shares were surging despite earnings missing estimates and cutting sales guidance. Well, now it seems that people have read through the story and the shares are down 5%. Cracker Barrel boosted its revenue guidance for the full year, beating the average analyst estimate. Wow, the stock is up 17%, which is a strong move for a stock like Cracker Barrel. Check on what's going on in markets right now ahead of the opening bell just 4 minutes from here. S&P futures down 0.5%. Still, NASDAQ futures down about 0.9%. You can see the 10-year yield unchanged at 4.52 and Brent crude holding at $92.42 a barrel. We're about to start the trading day with Morgan Stanley's Mike Wilson. This is Bloomberg. Moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We continue to see a sell-off, even though we've come back from lower levels. This morning, we were down more than 1% in futures on the S&P. Now we're down 0.5%. We are off on the NASDAQ futures about 0.9%. Dow Jones futures down 0.5% as well. So if you're watching this rotation, it's currently not helping the big indexes. Here on the New York Stock Exchange, EROC ringing the opening bell, gas generator company doing an IPO. So many IPOs. I got to talk to Mike Wilson about that. Einride, which is a Swedish autonomous trucking company, coming here to list on the NASDAQ. So another IPO there. In terms of the stocks I'm watching, NVIDIA, obviously the largest company in the world. When it moves down by 1%, that has an effect on the indexes on which it's so heavily weighted. American Airlines coming down. We're looking at the price of oil coming up, but any tech or travel stocks linked to inflation hedges like gold are falling as well. So Anglo Gold Ashanti down 5.5% after the latest CPI print came in a little bit lighter on the core than had been anticipated. Morgan Stanley's Mike Wilson still with us here at the desk. And Mike, we haven't talked about these gigantic IPOs. What do you make of the, I guess, animal spirits, right? Or else they wouldn't be here. And the mechanical effects on the market. Surely some people are selling winners to get into whatever IPO they want.
Yeah, I mean, look, the market's been very receptive not only to equity offerings but debt offerings. I mean, it's been another kind of bonanza year. Not as strong as 2021, but I mean that's a sign of a healthy market, quite frankly, when you're absorbing this kind of supply. So it doesn't bother me. I think the collection of stuff maybe all at once can create some digestion problems, but there's plenty of liquidity out there. I mean, I'll give you one statistic which I think will help maybe understand this. Companies distribute income, whether through buybacks or dividends, and they do about $1.7 trillion a year. That's just, income back to shareholders. Now, some of that's reinvested like dividends, but that's a lot of money, right? And then you have inflows from retail all the time and pensioners and asset owners. So there's capital out there. And so the fact that the market's absorbing these deals doesn't bother me. The collection in one quarter can create some, disruption, but I think there's capital to absorb this.
By the way, that goes to the heart of my main question. Watching this throughout the last months and years, right? Because spreads have been so tight and equity indexes keep running up. Investors have enough money to pile it into gold and things like Bitcoin. Where is all this cash coming from?
Well, don't forget, the bond market's been in a bear market for 4 years, okay? So what we're seeing is people are not reinvesting their bond proceeds, right? They mature, and they're putting into things that can actually protect them against inflation, something we haven't talked about yet. Like the average asset owner is pretty smart. They figured out that, hey, that the biggest risk going forward is inflation, which is kind of my thought. Then I want to own assets that will protect me against inflation. That's not bonds, okay? That's equities, it's gold, it's silver, it's other real assets, and that's what they're doing. So there's a tectonic shift, okay, from the 60-40 to something that looks more like 60-20-20 or even 70-30, depending on your preference.
So what is your take on inflation? Are you concerned it can continue to climb from here? Because 4.2% is a pretty shocking CPI number. If we hadn't all been through the sort of Biden-inflation era of 9, this would be insane. Yeah. And then the core looks pretty light at 0.2 if you just month over month.
Yeah, let me make something perfectly clear. I'm a headline guy, okay? I'm not a core guy making all these adjustments because I live in the real world. And by the way, stocks live in the real world, meaning like we don't take out certain things. I mean, one of the reasons why earnings are so good this year, which is part of our call, is that nominal GDP growth is accelerating, and half of that is inflation. So inflation is very, very good for earnings growth, and it's very good for stocks so long as the Fed isn't pulling away the punch bowl, okay? So the fact that the Fed is now talking about core PCE like they did in 2021 and kind of justifying why they're not raising rates when maybe they should be, we'll see later this year, then that allows multiples to kind of stay where they are. And so there's a lot of similarities to me to 2021, right? We have this incredible earnings story driven by higher inflation, pent-up demand, and we're seeing inflation kind of breaking above levels that are comfortable. The Fed is justifying not raising rates because of core PCE, and maybe there's some AI productivity boom coming, which there probably is, and they're gonna hold firm, and that's a recipe for higher stock prices. Now, we could run into trouble later this year if inflation continues to go towards 5%, and then the Fed's going to have to do something about it because they got to retain their credibility. So it's a very similar setup to 21, which was a very good year for stocks, but it rotated around. It's exactly what we're seeing right now, and I think it's going to be more of the same.
But I imagine your base case is that we don't get to 5% or more on CPI, that the Fed doesn't really do much beyond maybe one hike, right? And that we continue to have this nominal GDP growth that drives earnings.
Well, that's our base case, exactly. Yeah. Now, I think that sets us up for something maybe a little different for next year. We'll have to see, because next year we're going to have a real deceleration potentially in the growth rate, right? But between now and year end, that growth rate is going to stay probably north of 20% on a forward basis, which is pretty healthy. So I don't anticipate a lot of multiple contraction this year, but I think that could be an issue for 2027. We'll have to wait and see.
But this base case is why you like transportation stocks, why you like shippers. I mean, today's idiosyncratic, I guess, Amazon story aside, right, you think that the economy is continue humming along and that these guys are going to ship more stuff and have enough power to raise prices?
Yeah, what's really going on, Matt, is that the economy now is seeing real velocity in the private economy, right? We've had this thesis for a long time that we're seeing a rebalancing from the kind of government-driven economy to a private-driven economy. That's why all the payroll numbers now are in the private area. And there's real volume going through the economy. We got real GDP growth with volume for the first time in 3 or 4 years, which is driving a lot of these sectors that have been dormant, like consumer goods in particular, we think in the second half of this year. They were working earlier this year until inflation picked up and the war kind of evolved, but we think that comes back. Same thing for things like regional banks. Transportation is another area. And by the way, tech can work in that environment too. It just got a little overcooked here in the short term.
What do you make of the consumer? There's so much talk, probably far too much, about the K-shaped economy. Yep. But there are, many people struggling with higher prices that are having to decide whether to buy, cheaper food so they can put gas in their car. Yep. Does that not hurt the consumer stock story? It
doesn't hurt the consumer stock story because 80% of the spending is done by the top 20% or 30% of the consumers. So it's just it's not good for the people at the bottom end of that K. But my job as a market strategist is to say, is this going to change the earnings profile? And I don't think so. In fact, we saw it this morning, some more of these retail-oriented stocks, consumer consumption stocks doing quite well. And we think that's going to continue into the second half of the year, particularly if oil prices come back down.
All right. What a fantastic education. I love when you come on the show and we get to spend some time with you because I learned so much. Morgan Stanley, Chief U.S. Equity Strategist and Chief Investment Officer Mike Wilson. Let's get a check on what's going on in the markets right now. Just 7 minutes into the session, and we're looking at an S&P that is down, still about 0.5%, but at 73.50. So we have lost some ground over the past few days, but we're still at well over 7,000 here, which is something you may not have expected at the start of this war. On the gainers side, and there are 220 of them, you've got Applied Materials, KLA, ExxonMobil, as well as Lam Research and Koch. So some actually pretty small names on this side of the ledger. You typically see the big Mag 7 stocks up there. They're over here, right? Broadcom is not officially, I guess it's part of the Great Eight, as Katie Greifeld calls it. NVIDIA, obviously the leader of the pack. You've got Micron, which has been the standout stock this year. Microsoft, Apple, Amazon, and then Caterpillar, obviously an AI stock as well. All down today, and that's what's dragging stocks. This is the rotation out of tech stocks into those names that you haven't seen so much this year. Energy, the energy index doing well as oil turns around and starts to gain some ground. Consumer staples are also up, as well as real estate and materials. On the downside, you've got the IT stocks. This is the rotation out of tech that we're talking about: industrials, consumer discretion, and financials. That's what's happening in the markets at this minute. Coming up after weeks of volatility in tech, Oracle's results may be the next big test for the shaky AI trade. More with Anurag Rana of Bloomberg Intelligence next. This is Bloomberg Open Interest. Time now for our top call. Some of the analyst action in focus this morning. First up, RBC Capital downgrading Nike to a sector perform, saying the retailer's turnaround is slower and narrower than expected. You can see Nike shares down 1%. Next up is Piper Sandler initiating coverage of SharkNinja with an overweight rating, pointing to the company's impressive track record of new innovations and strong growth prospects. SharkNinja shares rising 1.33%. And finally, Cantor Fitzgerald raising its price target on Applied Materials to a street high of $650, saying we're at the early innings of an upcycle for the semiconductor equipment industry. And Applied Materials right now up 2.33%. You saw just a moment ago, adding the most points of all 500 stocks to the S&P. Tech stocks, though, are driving the market down this week, with the Nasdaq falling as much as 4% intraday yesterday. Now Oracle's earnings report after the close could be the next major test for the AI trade. Let's discuss with Bloomberg Intelligence senior analyst Anurag Rana. So Anurag, what do we expect? Set the stage for us for Oracle earnings this afternoon.
And now they should be very good. Their infrastructure cloud business is most likely going to grow around 90%, total revenue growth of over 20%. So we should not anticipate any slowdown in growth in terms of demand for AI infrastructure. The big question for them is going to be, just like everybody else, do they have enough power, enough memory, enough chips in order to fulfill that backlog that's sitting on their balance sheet? I think that remains the fundamental question for all cloud providers right now.
For these cloud providers, we talk so much lately about token costs and companies getting into hot water, using way too much. Are they making 100% of their money back on these tokens, or are they getting subsidized somewhere along the food chain?
So as far as the cloud infrastructure players are, whether it's CoreWeave or it's Oracle, they are getting their margins because they have bought the GPUs from NVIDIA, installed it, and sold it to the end market. It's really the end person who has to foot the bill at the end of the day. But at the same time, right now, the cloud infrastructure margins are nowhere close to what an older CPU-based cloud margins are. But that's just to be, you would assume that because this is so early in the cycle. But I would not anticipate that to have an impact for Oracle in that sense.
So what about the spending, the funding of that spending that we're seeing everybody, I wouldn't use the word struggle, but doing, right? Companies the likes of Oracle seem to be able to tap as much investor cash as they need. Is that going to continue here, Anurag?
So, I would say, as far as their debt offering is gone, I mean, they've done that and that's fine. But they also have another equity offering that they have to do as part of their full year plan. But that's the big question as to what price they're going to do it now, because, in the last, you would say, few days, the market's been actually going southwards. So I would have said that, they probably had a better window to boost that, share equity raise, let's say a couple of weeks ago. But if the political, climate improves and we see a rebound in AI infrastructure stocks, then Oracle will go out and issue those shares.
How will stocks like this be affected by the SpaceX IPO and the other massive, OpenAI and Anthropic coming after it? Because it looks like investors are freeing up cash, selling off Bitcoin, selling off gold, selling out of their tech winners in order to put money aside for these IPOs.
Yeah, it's actually a very good question on that end, and we will see how that shapes up. But when you look at that bucket of Anthropic and OpenAI, Oracle, CoreWeave are still in that bucket because it's part of the same AI infrastructure trade. I think the bigger damage that could happen to some of them is if rates keep on rising, because that really has an impact both on funding cost as well as the valuation of these high growth names. So there's a dual edge over there for the AI players.
What kind of valuations do you expect to see on OpenAI and Anthropic? I imagine they'll both be trillion-dollar plus IPOs, right? So are they going to be 50 times sales, 75 times sales when they go public?
Well, that's, I think, the biggest question at this point, because they already have a private, company valuation close to $1 trillion. The big question is, do the market still looks at only growth rate, or they're going to go start looking at free cash flow? Because we have seen that in the past that, when people are very excited, they only want to look at sales growth. But you see the first hint of a slowdown, then everybody start running and start looking at free cash flow. Look at Figma's IPO. When they came out, everybody was so excited. In the last, I think, 12 months or so, stocks down 80% at this point, because now everybody's focused on stock-based compensation and margins and what could happen with Claude. So there's a fair amount of uncertainty when some of these startups go public.
All right, Anurag, thanks so much for joining us. Bloomberg Intelligence senior analyst Anurag Rana talking about Oracle earnings coming up after the close. And also coming up after this break, private market titans sit down with Dani Burger. She joins us live from Super Return in Berlin with the latest next. This is Bloomberg Open Interest.
Companies are performing just fine, but doesn't mean you aren't going to see some accidents along the way. When things grow this fast, typically some things break. There'll be some losers along the way, and at some point in the next 2, 3, 4 years, there'll likely be some kind of shakeout.
The industry lost its way a little bit. I've been pretty vocal on that. The industry was founded on finding good assets, pay a reasonable price for it, operate it better. When interest rates went to zero and stayed there for a decade, the equation changed to find a good asset, don't screw it up.
In private equity, the environment is pretty stuck right now. If you're going to buy a technology company or a software company, a solution provider to the enterprise, now you really want to see that they're making a lot of progress around their AI offerings.
There are entire sectors, Dani, like private equity, like real estate, which are constipated, right? They can't sell. I think on balance, it's also fair to say, my God, there are lots of the canaries in the coal mines are telling you a bunch of stuff.
Those were just some of the power players speaking with Dani Burger at Super Return, Europe's largest private equity conference. Dani joins us now from Berlin. Isn't that the biggest private equity conference in the world? I mean, what's bigger than that?
I don't know. I mean, I guess Milken and Davos have a lot of private equity people at them, but this has got to be the biggest, pure private equity. And I got to say, I was just listening back to those interviews and the people around here. There's a real sense of anxiety in this industry. I mean, you heard from the speakers there that things aren't clearing. Victor Kosla used the word constipated, which I guess is quite evocative. But I mean, people are here. The mood is still good. There's not any less attendees here. So even though there's this idea that things need to be worked through, there still is just this underbelly of optimism. And I guess at the end of the day, these are deal people, and they are here to get deals done. So they kind of have to be optimistic to some degree.
Is it super returns that investors are seeing from this sector right now, Dani?
Are you saying, are there super returns that they're seeing?
Yes.
I mean, I think there's this idea that on paper things look good. And the things that have been sold, those have looked good too. But what about everything else that has just been backed up? So basically all the IPOs, of course, we talked to Liftoff last week, the CEO. That was huge returns for Blackstone. We're going to sit down with Martin Brand in just moments about that. I spoke with General Atlantic, who was also part of that deal. So private equity things that are IPOing, that are exiting, they're really strong, but these are the best assets. There's this kind of other class. It's these middle returns, these middle managers who maybe have smaller assets that are struggling to find a home for them, that they're not finding buyers. That may be seeing less returns. Private credit, too, just given the rate environment, mathematically has lower returns as well. And you're seeing that with an impact for the LPs. The LPs, I've been talking to manager after manager. They're sitting down with these managers and saying, listen, we want to consolidate. We don't want as many platforms. We're not going to be giving as many people as much money. We have money to spend, but it's going to be with less people. So you're really feeling the ramifications, and it's another year where people are saying consolidation, marriages of convenience, of inconvenience, it's going to be happening at pace.
What are you hearing, speaking of private credit, about redemption requests, and how much has that spread over to private equity?
They love to say nothing to see here, that it's being worked out. I think there is a feeling that redemptions will stay elevated, but it's the refrain, Matt, you and I have heard so often, that it's a small part of the industry. Even though it's a small part, though, it is dominating the sentiment. On one hand, you have LPs asking serious questions about what's going on, what impact that has. But in the same vein, people who aren't facing those kinds of redemptions, that don't have the wealth product, we spoke to Sixth Street about this, as well as Ken Kinsella of Churchill. It's kind of a great time because people have been pulling back. Process for private credit are less competitive because all of these BDC players aren't present in the market right now. They're kind of being iced out. So for those who can still compete, it's been a really, really good environment. But still, there's a lot of explaining to do. I spoke with Blair Jacobson of Ares, who said that the panic among retail investors, it's just psychological. It's not returns itself. So it's still an industry that is trying to explain itself and say, hey, the fears you have, they're not real. Look at the performance. It's still okay.
We are seeing big IPOs. There were IPOs ringing the bell at the NYSE, IPO ringing the bell at the NASDAQ. Obviously, the biggest IPO in history happens this year, and it'll be followed by two other of the biggest IPOs in history. Exits seem healthy right now.
Yes, but I don't know if they're going to continue that way after this SpaceX IPO. I sat down with Jeff Pearlman, and we'll be hearing him on Bloomberg Deals, which I know, Matt, you're so kindly anchoring for me today. So you're going to hear this conversation I had with Jeff Pearlman of Warburg Pincus. And I think it's really key because I asked him, are these IPOs good for private equity? Are they bad? He essentially said that because they're hoovering up so much of the attention, it's going to take people out of the IPO market for a little bit, that you have to sit, you have to wait maybe a couple of months before you can really dive back in. That was actually something specifically Orlando Bravo said, this idea that maybe you need to wait things out for the IPO market to be able to go back in. So that was Orlando's comment specifically. So yes, IPOs are kind of back, but for private equity, again, Jeff's comments were more, IPOs are not the right exit strategy for private equity, that the public markets are shrinking and too many people have found themselves saddled with assets where their only route is to IPO. So something's a little bit broken there. So yes, exits are starting to come back, but I think IPO exits are going to be maybe perhaps more the exception, not the rule.
All right, really fascinating stuff, Dani. Thanks so much for joining us on your show. Dani Berger there from Super Return out of Berlin. She's going to sit down, by the way, a little bit later on in the program with Martin Brand, the head of Blackstone Capital Partners. Definitely an interview you don't want to miss. Coming up next on this program, RBC's Lori Calvasina reacts to the latest inflation read and the sell-off. And then Elon Musk confidant Scott Painter joins the show after that. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Dani Berger is on assignment, as you just saw. She's going to join us later this hour from Super Return in Berlin with Martin Brand of Blackstone Capital Partners. Coming up, a relatively tame inflation report brings some relief to Wall Street with stocks crawling back, or I should say clawing back losses, crawling back to unchanged. Meanwhile, President Trump warns Iran will pay a price for taking too long to negotiate a peace deal. Those negotiations that have been going so well are taking too long. And SpaceX fever is going global, with institutional investors and sovereign wealth funds, especially in the Middle East, piling into the biggest IPO in history. But we begin with the economic data. Let's bring in Michael McKee, Bloomberg's international economics and policy correspondent, for the details of what I loved. We had Mike Wilson on earlier, and he was like, hey, Matt, you know what? I live in a headline world, right? And so do stocks.
So do consumers. And that's why we're seeing some of the reaction that we are today. Let's take a look at how various people are affected by the CPI. And we'll start with consumers. You take a look at where the inflation was. It was in gasoline and energy prices. Gasoline prices up a surprising 3.9%. There was a thought that they had gone down a little bit towards the end of the month. Groceries, though, were a break for consumers, up just 0.1%, and housing is up 0.3%. That's the owner's equivalent rent, and that's a little bit lower than it had been. Car insurance, big break, down 1.7%. That helps Matt with his muscle cars in his driveway. But here's the bad part for consumers. Real earnings, you take inflation away from average hourly earnings, and they were down 0.7%, worse than the 0.3%. So you put that together with gas prices, and maybe you have some unhappy consumers out there. For Fed officials, it's also a bit of a problem, because you're looking at the 3-month moving average is now up to 8.2% for headline inflation, and that is not good news if you're trying to hit 2%. Core goods, though, down 0.1%. Supercore services up 3.5%. That's ex-housing. And the story there is we seem to be getting past the effects of tariffs in inflation, but we still have this stubborn services inflation underway. And that is something the Fed is going to worry about. And then for investors, tariff inflation is tailing off, but there's more to come probably when he puts new tariffs on. War-related inflation is slowing, but the levels are still high, and you'll feel that at the grocery store. Fed likely to hold neutral bias for months now. Markets are still pricing one rate hike by the end of 2026. So there's good and bad for everybody here, and we kind of end up with a status quo.
All right, Michael McKee, thanks very much, Mike, talking to us about the inflation number. That inflation report helping to steady nerves on Wall Street despite the recent volatility. Morgan Stanley's Mike Wilson is maintaining a bullish outlook.
As we go forward into next year, that NTM, forward earnings, is going to continue to rise. And that's our call. That's why stocks continue to rise into year end. Multiples don't have to rise. It's just a forward. You move forward into 2027 as you look forward for 12 months. But the rate of change matters. In the short term, it matters. And that's what's going on right now. That to me, that's going to lead to some leadership change, just like it did earlier in the year when we went from gold and silver stocks to metals to energy. And then we went into DRAM and semiconductors.
Joining us now is Lori Calvasina, RBC Capital Markets head of U.S. equity strategy. And do you agree? I mean, we were looking, Mike and I, at earnings revisions, and they continue to rise here into 2026, into 2027, just higher and higher.
So, I think when Mike and I both like to look at earnings, he calls it earnings breadth, I call it earnings sentiment, but the rate of upward revisions is what I tend to focus on in terms of the specific stat. And what's interesting now is that the S&P 500 does look pretty elevated. That has really, helped to get us here to where we are, the strength of the earnings backdrop. But to me, what's really interesting, and I think I'm kind of like the queen of nuance and digging down into the weeds, but if you look at the top 10 market cap names in the S&P 500, that's where all the weight is, that's where all the earnings are. And essentially, we were back to 89% upward revisions on our last update. That topped out in the fall at 86.5, and historically the peaks tend to be, 90 to 94. So on this most important cohort from a sentiment perspective around earnings, it may be about as good as it gets. That doesn't mean things are about to fall off a cliff or we haven't, sort of deserved all this move that we have, but we really are just sort of at a point where that trade may need to pause and take a breath. If you look at the rest of the market, we are starting to see, a big improvement in the rate of upward revisions as well. I think that one still has a little bit more room to go. And when you then take those same cohorts and look at valuations, we've also seen those top 10 market cap names had recently been trading above 30 times. The high tends to be in the low 30s, and the rest of the market, the PEs had actually compressed and gone back down to average. So from both sort of an earnings perspective and a valuation perspective, it does look like we need sort of a short-term pause in this leadership of the mega cap growth stocks. Because of their weight, that's going to be difficult for the market to absorb.
So which of those stocks, because I was looking at all of them today with the EE screen on the Bloomberg for their forward, out 12 months PE, and I still see like 20s or low 20s for many of them. NVIDIA right now, forward 12-month PE is 20.59.
Yeah, so we tend to look at a median when we're looking at that specific, kind of top 10 cohort. I can't go into individual names, but we do see, certain names will distort that, and that's why we like to look at the trend over time. I will tell you that stat has actually come down a little bit now. The high point we were tracking above 30, and now it's more like, I think, 27, 28. So it's been coming down a little bit, but we do think very recently we sort of hit, kind of the 100.3 degree when the kids have to stay home from school, right?
Yeah.
We sort of think that temperature gauge, got a little bit overheated recently.
So if this is a rotation, and Mike was saying, he was describing it in terms of commodities, but if you look at it in terms of stocks, out of those top 10 biggest performers, what are investors putting their money into?
What's interesting is the conversation, I would say, over the past month has been, hey, and I saw this in particular on a trip to Europe recently, was I'm in the semis, I'm in the AI names. I'm sort of sensing people wanting to take a little money off the table and wanting to look at other things. And when you look at other choices in the market, I think it gets really hard for people, which is why I do think this pause is ultimately short-lived. I think it's needed, but, some of the sectors we've been talking about, I would say one is healthcare. Now, that's a sector I'm neutral, but one of the things that started to appeal to people in looking at that sector is that it does seem to be a hedge against the technology sector. We've started to see a relationship develop that when tech underperforms, healthcare outperforms, and vice versa. So they're not going to work at the same time. And there's some challenges around earnings revisions there, but at the same time, people have been intrigued with that space and like the valuations. I would say another one is financials, where we're starting to see inflows aren't back, but flows are getting less negative. And you've had some, really compelling valuations develop around things like banks, insurance, and consumer finance. It's also a sector that tends to work when consumer confidence turns around. And I think materials is one that always comes up. And I'll tell you, Matt, I'm also neutral this sector, energy. But again, going back to this trip to Europe, this is a sector that in recent years people in Europe just haven't wanted to talk about. Like, we don't even bother bringing it up. And I'm not sitting here telling you everybody was bullish on it, but people were willing to talk about it a lot more than they have in recent years. And part of that is because we're in a geopolitical world that looks like it's not going to get any easier anytime soon. So energy, people's ears perk up based on that basis. And the valuations still look pretty good, and the earnings revisions are turning around. And we had our energy conference at RBC recently, and I joked, we really didn't hear much about the war. We heard an awful lot about data centers.
Interesting. I wonder if, I was talking about this with Mike also in the breaks, I wonder if this closure of the Strait of Hormuz and, Russia invading Ukraine is forcing the Europeans to finally be like, you know what, we have to drill here. We have that big gas field in Groningen, let's go get it now.
Well, I was thinking back actually to, sort of the 2024 campaign when we were doing a bunch of research around both parties, and then a speech that Secretary Bessent gave, I guess this was last year, I'm losing a little bit track of time. But, some of the themes early on from this new administration, right, were sort of the intersection between economic security and national security, right? And so are we, we're constantly talking to investors when we discuss the longer-term year-ahead outlook. What are the new post-COVID rules of investing? That's going to be very different from the post-GFC era. We're deglobalizing, but that has implications for national security as well.
Just finally, want to look at, I'd look at all the sectors year-to-date in the S&P, and consumer discretionary is one of the big losers. There's only two big losers. What's your take on the consumer? Because Mike's point was, it sucks, obviously, for people in the lower half of the K, but 80% of the spending is done by the top 20%.
So we're actually underweight the consumer discretionary sector. Out of the 11 GIC sectors, it's our only underweight right now. We're market weight most sectors. We have a couple of overweights, but we are neutral on consumer staples. And I have found talking about the contrast between the two has been interesting. Staples valuations look cheap. Consumer discretionary does not. It doesn't look wildly expensive. That's what we see for things like industrials. And, we did an analyst survey back in April, and our consumer discretionary analysts did say, this is a sector that should do poorly if we have an extended war. On a rebound, we de-escalate the war, get to peace, the sector should do better. So we are mindful of that. But I'll tell you again, going back to this trip to Europe, we talked a lot about, sort of the concept around the consumer of what's been de-risked. And so as I was talking to investors, this idea that Staples, we know what the problems are. We know they've got a little more exposure to the lower income consumer. We know those consumers are pressured from the situation in the Middle East, inflation and all these other issues. But maybe we should be more worried about something like industrials, where companies have been saying they can manage through just fine and you've got sky-high valuations. Maybe we should be more worried about consumer discretionary, which doesn't look as cheap. And so I really thought that theme of look where we know the problems are. They've already come out. They're already well discussed. They're already baked into valuations. I think that is a thought that is starting to form in investors' heads, and we need to keep an eye on that theme going forward.
It's always awesome to have you in here, Lori. Thank you so much for joining us. Lori Calvasina there from RBC Capital Markets. In terms of what we're watching happen on the benchmark indexes right now, we're still seeing losses, but only 0.1% on the S&P and the NASDAQ after a lighter than expected core CPI number came in month over month. You've got to get really specific to find the good news in inflation, but investors are doing that right now. Coming up, we're going to head back to the Super Return Conference in Berlin for an interview with Martin Brand, head of Blackstone Capital Partners. This is Bloomberg.
The industry lost its way a little bit. I've been pretty vocal on that. The industry was founded on finding good assets, pay a reasonable price for it, operate it better. When interest rates went to zero and stayed there for a decade, the equation changed to find a good asset, don't screw it up. What you paid for it didn't really matter because at 0% rates, valuations always went up. When all of a sudden, in 2022, 2023, we saw rates move 500 basis points, that changed everything. Folks are going to have to start capitulating for sure.
That was Apollo co-president Scott Kleinman speaking with Dani Burger at Super Return, a private equity conference in Berlin that I suspect is the biggest in the world. Dani is there now with Martin Brand, the head of Blackstone's flagship PE strategy. Dani, take it away.
Matt, thank you so much. Can I just clear this up here? Martin, my co-anchor, and I, Matt, were having this debate as to whether Super Return is the biggest private equity conference. It is, right? Like, there's no other gathering of this size of people.
I believe so. It's huge here in Berlin.
Yeah, it's definitely. I mean, how's the mood been, by the way? Just in your meetings with people, with all your LPs, with everyone else? What's sort of the vibes you're getting at the moment?
I would say the mood is definitely a little bit subdued. One of the topics is the lack of exits. That, in particular, in the mid-market is an issue. Frankly, a lot of those assets have only private equity as a buyer, and there's not enough dry powder out there. But for us, it's different. We focus on larger companies, high-quality companies. Those have strategic exit optionality. They have typically an IPO exit. We actually returned $14 billion since January 2025. Did a lot of IPOs, just did the liftoff IPO last week, which has been a great success. So our strategy, our exit engine is working.
Can we talk about liftoff, Matt? And I spoke to your CEO, who is very excited. Obviously, it got a nice first day trading pop. Where do you think this ranks in the success of Blackstone exits?
Well, it's certainly a very good one for us. And this one was personal for me. Thank you for having Jeremy on the show. Jeremy is one of the very best CEOs that I've ever worked with. And we tried to go February last year, and it was a brutal timing. It was the week of SaaSpocalypse. So we had to pull it, but we backed the management team. The company kept on performing, and we went in June. Frankly, the banks advised us not to go, and we ignored that advice. It was the right call. We had one of the shortest, I think the shortest TMT roadshow in 6 years. We're 11 times oversubscribed. We priced above the range. We made 10 times our money. So a fantastic return for our investors. And it's our third IPO this year, and they come on the back of Medline, where we made over $4 billion for our investors in 2025 in September. Then Legions, which has traded up over, I think, 150%. We have 7 more on file, so the year of the IPO is definitely on.
So are you just done listening to your bankers then, who are saying don't IPO in the shadow of these bigger ones? Or do you think there is some nerves around SpaceX, OpenAI, Anthropic as we go on?
Well, I think if you look at something like a SpaceX coming at 75 billion, that certainly I can see how that will feel daunting to people. But compare it to Blackstone Q1, we raised $70 billion. So as long as the performance is there, I think there is demand for IPOs. And Liftoff shows that. And our generally oversubscribed IPOs show that.
It's always fun to look at what Blackstone businesses are coming to market because you have a very digital age Liftoff, an app company, and then there's always hopes that maybe we'll get Jersey Mike's coming public. Might that be one of the 7 that we could see this year?
We love Jersey Mike's. It's a fantastic company. I love eating the subs, so hopefully, it's
Are you
interesting.
contractually obligated to eat the subs, Martin?
I will eat the subs every day. Nothing is better. The Italian is my favorite.
So, I mean, that's really interesting because, again, it's 2 different types. Do you think that that's the way this market's going to be bifurcated? Tech, really successful, maybe even AI-adjacent companies and real-world companies, and everything in between is kind of iced out?
I would say there's truth to that. The demand for AI is very, very strong, and I think defensive assets get bid up. If you're in the middle, I think it depends on modes and it depends on growth. So if you take Liftoff as an example, it's had 30% growth. And so it's neither really an LLM, not a purely defensive play, but because the return potential is there, the investor demand is there. And that is a proof of generally how our IPOs have performed.
So just to be clear, you don't subscribe to this model that because SpaceX, OpenAI, and Anthropic are all competing for the same institutional capital, that it dilutes the supply out there for you, or the demand rather, that there's too much supply. So that doesn't really concern you, this sort of dynamic that's emerging.
Well, I won't comment on anybody else's IPO, but I will say as long as we have returns, investor demand, in my view, is there.
One of the other interesting deals you did recently was this AI services company with Anthropic, and then alongside that, you also committed $5 billion to an infrastructure JV with Google around TPUs. What's the TPU strategy specifically? Why enter this deal with them?
Yeah, so maybe let me start by explaining what a TPU is. A TPU is an AI chip. It's used to train and run AI. Gemini was trained on TPUs. Claude Opus 4.7 was trained on TPUs. Sorry. Right. It's a very strong chip. So we committed $5 billion, 500 megawatts, to a partnership with Google to build a neocloud. And you might ask, what's the rationale? Why now? And that is increasing demand, in particular if the agentic economy takes off. And at the same time, the physical supply is constrained. It's hard to get a data center permitted. It's hard to get the power. It's hard to get the chips. So as a result of that, the capacity is very valuable, and we're proud to be partnered with Google on this.
Does that mean your portfolio companies get advanced access, or they're prioritized for access for some of the infrastructure there?
I would say this infrastructure is more typical for large AI companies, training models, but the Anthropic partnership that you mentioned is one where we're excited about making great engineering talent available to our portfolio companies. We're close to the Anthropic management team. The CFO, Krishna Rao, actually used to work in Blackstone Private Equity. The head of strategy was an analyst in our group. The head of capital markets came from Blackstone. So we have deep trust. And what this Anthropic partnership is about is making real engineering talent available to the companies that work with the Anthropic partnership.
So you basically have Blackstone to thank for Anthropic and Claude, is what I'm hearing from you.
I think they are just fine without us, but we're proud to have partnerships.
How are you approaching just the cost of this stuff? These stories keep cropping up of a consultant hears some story about a client that accidentally spent $500 million in just the span of a month because they weren't tracking their token budget, or Uber blowing through their entire year's budget in just a couple of months. As you're making companies more equipped with AI, how are you handling just the pure inference and compute costs that seem to be growing?
Yeah, I would say those headlines about crazy spend, those are lack of controls. They're growing pains early in the AI revolution. I think it's more important to focus on the longer term. And longer term, what I think will happen is the demand will increase. It will likely exceed the supply. And when that happens, the value created will set the price. And there will be a paradigm shift, and that could very well lead to an increase in the token cost We've actually seen that already, and it will particularly benefit the frontier models.
That seems not great for margins if the whole project of this thing is also to make companies more efficient and decrease margins.
I think the bidders on this will bid to make a return on any token spent or anybody who procures it. And for the TPU partnership that we mentioned, which will have compute capacity, that'll actually be a positive.
Right, Martin, we're going to have to end things there. Thank you so much for joining.
Thank you.
Such a pleasure to see you. Come join in New York again sometime soon.
I would love to.
I'm going to hold you to that, Martin. Thanks so much, Matt. That is Martin Brand, Blackstone.
Cool to get Martin's take on those things. And Dani, great to see you as well. Have a great time at the conference. Stay tuned for more interviews from Super Return tomorrow, because Dani is going to speak with Neuberger Berman's head of Europe Private Equity, the co-head of Vista Equity Partners, and Reddit co-founder Alexis Ohanian. Plus, I really hope she goes to Cat's Orange for dinner. The pork there is absolutely superb. President Trump praises Citi and CEO of Citi, Jane Fraser, in a Truth Social post. He just reached out and said congratulations to her and her team on the bank's, quote, big comeback, and highlighted Citi's top ranking in first quarter M&A activity. For more, let's bring in Bloomberg's banking reporter, Todd Gillespie. He covers Citi for us, and I was using the M&A function, MA-Go, on the Bloomberg terminal. You can click on the league table and move around some variables. I was trying to see, could I get Citi to the #1 position in the first quarter, and I could not. Are they really?
No, Matt, is the short answer. And frankly, maybe we should be getting a terminal in front of Donald Trump to show him the layout, the MA function, MA-Go. But basically, yeah, it's been a bit of a shock this morning. Trump sort of, apparently from nowhere, just seemed to tweet, post on Truth Social that Citi is now the #1 M&A shop on Wall Street, and basically is saying, you know, they used to be nowhere and now they're somewhere, which as a narrative generally for the bank is not all that far off. But it does, you know, they have been improving more recently. They've been hiring top talent from JP Morgan and other banks across the street. But this really has sort of come as a bit of a blinder. I think what it does say, though, is that Trump has given quite a rare piece of praise to a banking CEO, which is very, very rare for him, full stop. Bear in mind, Trump was debanked by, or claims he was debanked by, some of the largest US banks, not Citi, though, in the wake of January 6th. And he's had stern words for people like Brian Moynihan and Jamie Dimon in the past. But Jane Fraser, the Citi CEO, has largely avoided his ire. And in fact, we know that Eric Trump, we reported back in August, became a client, or sorry, in October, became a client of Citigroup and has set up a trust at the bank with Donald Trump's money in. So the proximity between the two entities has increased somewhat recently.
Yeah, so I look at the MA-Go function, I click on league table, I put in Q1, and then I only look at M&A. By total deal value, Goldman Sachs reigns supreme at more than $1.5 trillion in deals. Then JP Morgan, then Morgan Stanley. Citi comes in fourth at $780 billion. Does that make sense?
Yeah, I mean, more or less, that is a good estimate of that. It's a good ballpark for how the rankings look right now. And in fact, if there is one big M&A story on Wall Street right now, it's why is Goldman Sachs' lead so big? Obviously, given that Trump has mocked David Solomon for being a DJ in the past, and doesn't have loads of kind words for him, he's probably more happy to be congratulating Jane Fraser than congratulating John Waldron and David Solomon and the investment banking heads of Goldman Sachs for a great lead in the league tables right now.
All right, Todd, great reporting. Thanks so much for joining us. Todd Gillespie covers Citi for us. Coming up, we're going to speak to the CEO of Seanergy Maritime on what's driving global shipping demand right now. This is Bloomberg Open Interest. The spotlight remains on the Strait of Hormuz and the risks to global trade from the conflict in Iran. But for dry bulk shipping, the bigger story may be the continued strength in commodity demand. Asian countries are building coal stockpiles ahead of the summer, while infrastructure spending and growing energy needs continue to drive demand for raw materials around the world. Joining us now is Stamatis Tsantanis, Chairman and CEO of Seanergy Maritime Holdings, founder and CEO of United Maritime as well. Stamatis, great to get you on this program to talk shipping. Let me first ask about your take on the importance of the Strait of Hormuz. There was a time when analysts would tell us if that closed, we would see total catastrophe in the energy markets. And that just doesn't happen. Is it maybe less important than we thought to begin with?
Well, good morning, and thank you for having me. Actually, no, it's extremely important. The way that we have been losing so much barrels of oil and natural gas from the markets, it's kind of tremendous. The way that it hasn't really been a catastrophe so far is the fact that we have been using a lot of the inventory. So that's going to run out pretty soon. So, you know, it's just a matter of time where we see a big, big depletion of the global reserves of oil and natural gas, from what it seems.
So my kind of optimistic assessment was that maybe investors and industries were finding alternate routes, and you operate some of those alternate routes. So have you seen increased demand for other routes as people can't use the Strait of Hormuz?
Well, there are certain aspects of the energy market that are kind of irreplaceable. You cannot replace oil from a number of, the petrochemical industry or jet fuel or things that are pretty important, very important in our daily lives. So that goes without saying that it's kind of irreplaceable. There are, of course, alternative routes. The U.S. has come in to, pick up the slack in a number of ways of the global oil demand, but this is not close to being enough from what it seems for this year. So we're still eating a lot of the reserves. And of course, longer distances means longer ton miles, more ton miles, and that makes freight to be more expensive for everybody, and most importantly for the consumer, the end consumer paying for everything.
What about the coal shipments, the stronger coal shipments headed to Asia? Is that a temporary, energy security trade due to the closure of the strait, or is that a longer-term reality for coal and for Asian economies?
Well, there's a number of power plants in the Far East that are being fueled by coal, and there's more and more of them being built as we speak. So the recent crisis in the Hormuz and the Persian Gulf, it's just another giant alarm bell that the world should not be so much reliant on oil to the extent possible, of course. So coal is becoming dominant again for two reasons. Number one, we are replacing the current energy required, for day-to-day lives, especially in the Far East. China has been restocking massive amounts of coal in the recent months. And most importantly, coal is also becoming a strategic commodity for the United States. You are exporting more and more quantities of coal to the west coast of India and a number of other places in the world. So coal, I'm not saying it's going to become dominant over the period of the next 10 years, but it certainly in the short term is becoming quite important in the energy market.
I think about energy, and we talk about energy so much when it comes to the big data center build out, the AI infrastructure. You point out, though, Stamatis, that it's also steel, aluminum, iron ore, bauxite that's needed for putting up data centers, for grid improvements, obviously for EVs to build the cars to begin with. Is that visible in the cargo flows today?
Of course. And this is exactly what we do. We transport the world's most important commodities, raw materials for infrastructure. You have trillions of dollars of global infrastructure projects all over the world. You have now the data centers, which also is going to be trillions of dollars of demand for aluminum and steel and all that. So that's what we do. We transport iron ore, bauxite, and coal required in order to produce these super required, commodities for the world growth of tomorrow. So it's not just the energy market. It's, simply all the infrastructure happening around the world, which we kind of been neglecting given all the crises that we have to deal with.
Your diesel prices have, I imagine, risen substantially. Tell us about those costs for you and how well you've been able to pass them on to your clients, your consumers.
Well, as I mentioned before, freight is becoming more and more expensive. So at the end of the day, the consumer is who pays for all this increased costs. So increased bunker fuel for our ships, as well as a massive increase in ton miles that is required to go around all these problematic areas like the Red Sea, like the Persian Gulf and all that. that is an increasing inflationary pressure for the consumers. There's nothing we can do about it. I mean, there's no way that you can cut through, a military or a war zone. So unfortunately, all the ships have to go around certain areas like the Cape of Good Hope and all these other critical areas. So unfortunately, all that is being translated to the end consumer.
You also have a fleet renewal program and you pay a dividend. How do you balance returning cash to shareholders with buying new tonnage before, I guess, the next cycle turns or the war ends?
Well, right now our new building program is close to and exceeding soon $500 million. So we're in the process of renewing our fleet over the course of the next 3-4 years, but still returning capital to our shareholders and generally, dividends and cash back to our shareholders is for us paramount importance. So we will continue doing both, not only replacing our fleet and renewing with high quality assets that will be delivered to us over the next 2 to 3 years, but also we will continue a very strong return to our investors. Something I also wanted to mention about before, which is again close to the energy markets, it's the El Nino effect. Don't forget that 2026 forecasters believe there's going to be an 80% chance of El Nino. And that means that there's going to be a very increased need for energy happening from the summer months and towards the second half of the year. China, Far East, Japan, all together, and Korea will be in massive needs of energy, and that cannot come from oil and natural gas being trapped in the Persian Gulf. We're talking about massive amounts of coal happening in the next few months as well.
All right, Stamatis, great to get some time with you. Really appreciate you joining us. That was Stamatis Tsantanis, the Seanergy and United Maritime CEO. Let's get a check on what's going on in markets right now. We have green arrow on the NASDAQ. So tech stocks have actually turned higher after the drops that we saw yesterday and Friday. It looks like investors are buying the dip here on the slightly cooler core month-over-month inflation numbers that we got at 8:30 this morning. That hasn't turned the S&P positive yet, but it's only down 0.1% by the time Romaine and Katie get on air. We could see green arrows there. In terms of the 10-year yield, it's very little change, 4.52. We've seen that all morning, and we've seen crude turn around from losses to gains, but still holding at just under $93 a barrel. Let's get a look at some of the single stock stories we're following for you at this hour. Super Micro Computer is raising $7 billion through equity offerings to fill its AI server orders, and that equity offering is driving the price down, as you would expect from dilution, 15%. Trucking stocks like Old Dominion, FedEx Freight, as well as others are plunging. This after Amazon announced an expansion of its own shipping service to destinations across the U.S. Amazon down as well, but it's hurting the others more. And Cracker Barrel is boosting its guidance as the restaurant chain focuses on improving its food and service, as well as having more appealing product displays at its retail stores. I don't know how much more appealing they could get. It's already an awesome place to shop with the kids. Coming up, a rare look inside SpaceX's early days. We'll speak with longtime Elon Musk friend and advisor Scott Painter of TrueCar next. This is Bloomberg Open Interest. SpaceX mania reaching a fever pitch with sovereign wealth funds and institutional investors piling in to the record-breaking IPO that will also attract millions of retail investors. But long before SpaceX became a global powerhouse, it was a startup fighting for survival. Our next guest had a front row seat. Scott Painter is a longtime friend and advisor to Elon Musk, an early SpaceX investor. He's also the founder and CEO of TrueCar, the largest online new car marketplace. And essentially, Scott, you started online car buying many years ago. Let's talk, though, first about your friendship, your relationship with Elon Musk. He has had doubters since starting Tesla, and it seems that they're getting, I guess, weaker and weaker, fewer and fewer when it comes to his new business ideas, because nobody now doesn't believe that he's going to have data centers in space. What are investors really putting their money into here?
Well, I met Elon in 2003. He bought my house here in Southern California when he moved to LA after his PayPal days. But I can tell you that he is sort of the king of the big idea. And over the last 24 years, it has absolutely been the case that betting against him is a bad idea. I mean, he really puts out a very big idea, a big, hairy, audacious goal, as they say, a BHAG, but he consistently delivers. His timelines are maybe a little bit longer sometimes, but one of the things that's interesting about Elon is, he's an engineer at heart, and engineers really do look for what's going to go wrong. But in this case, he happens to be one of the most optimistic and curious humans I've ever met.
So what did you see in I guess, Elon or in SpaceX that made you a believer or made you an investor in that company's future?
Well, it's all about Elon. At the end of the day, SpaceX is one of the most important infrastructure projects of our time. It's obviously about bringing the internet to everybody, changing how humanity communicates. But I think this idea that we want to be an interplanetary species is really something that Elon believes in. He's a very mission-driven human, and the things that he is doing are all an extension of his belief system. And so he's very, very authentic. What I've seen as a friend is the level of loyalty and how deeply human he is. I mean, he's a very, very charming person. He goes deep with his friends and the people that he knows well. He's fiercely loyal, and he is nothing if he's not consistent in everything that he does.
So, some of the numbers that we see are as out there as the ideas, right? The total addressable market of $28 trillion that they put in their prospectus. Forecasts for sales, I think Morgan Stanley has them sales at $3.4 trillion in 2040. You think those numbers are realistic? Are those goals achievable? 1 million people on Mars, is that really a possibility?
I don't know that 1 million people on Mars is the real issue. I think if you want to look at sort of where things are headed with SpaceX, you have to really unlock your thinking from traditional market paradigms. I'm a 3-time public company CEO. I'm a lifetime entrepreneur. I very much live inside that box. I understand the 5-year discounted cash flow analysis. I understand that, even today we're talking about, SpaceX trading at almost 100 times forward earnings. That is absolutely astronomical. But at the same time, you cannot cap the upside potential. And I believe that companies trade on one of two things, either potential or performance. In Elon's case, he's proven that he can perform, build companies that not only scale, but that are very, very profitable. I think that in the case of SpaceX, which has been profitable and really a very big cash generator, you can't really apply any of the traditional market metrics. And he certainly doesn't think like a traditional CEO. He's not constrained by the kinds of thinking that, I have to live with every day. I try to emulate a lot of what he does, but he is really thinking about things, people say 3-dimensional chess. He really is out there. I would not try to apply any conventional thinking to the forward thinking about where SpaceX can go. It is really a bet on the future. And I think Elon isn't just a generational entrepreneur. He is a unique entrepreneur. He is one of a kind.
By the way, how do you, Scott, put sort of Elon Muskisms into the business that you do? As you say, you're a serial entrepreneur. You started car sales online with Cars Direct. You started a vehicle access model, subscription model with Pare and autonomy. How do you put Elon Musk's, I guess, strategies into the businesses now that you're running TrueCar again, into the businesses that you run?
Sure. Well, I think one of the things that's really important is entrepreneurs, visionary entrepreneurs, have to have a vision. And being a visionary is about seeing something that others do not. So you've got to really have conviction about what you're doing. I do believe that great companies, great entrepreneurs, and I know Elon believes this, solve problems. He is really the ultimate problem solver, not just what he's doing in front of him, but everything he sees is a problem, and he looks at it as an engineer. But he has this very famous worldview about first principles. And when you look at your business in a first principles way and you really get to the essence of a problem and understanding the truth behind it, it really realigns what you need to do and what you need to prioritize. And we're absolutely doing that at TrueCar in the turnaround. I talk about first principles all the time. People do not fundamentally understand it. You need to spend a little time really digging in to what does it mean to be a first principles thinker. And what you're looking for is the essence of a thing and why it works. And then you focus on solving those problems first. And that is a radical shift in how traditional business thinkers have to prioritize.
Elon Musk changed the way the world operates in terms of cars with Tesla. And with SpaceX, it looks like he's changing the way we think about the future of business as well. How do you think he would judge his dalliance in politics, you know, his collaboration with President Trump, his work at Doge? Does he see that as a success?
Well, I think that he is authentic and he believes in the things that he believes, and that first principles thinking he's applying to a bigger stage. And his venture into that was, for those of us who know him, it was an extension of Elon. I think that most people would say that that came with a cost, but he's also got the ability to endure any kind of criticism if he believes in a thing. And this is exactly the point. I mean, he is not going to be, taken off mission if he believes in that mission and fundamentally understands it. I think he still believes in the mission that he engaged in there. And I mean, the things he is doing is about really helping humanity to save free speech. And he believes that this is a very, very critical issue to our long-term success and survival as a species.
All right, Scott, great to get some time with you. Hope we can touch base next time you're in New York. TrueCar founder and CEO Scott Painter. Coming up, President Trump warns Iran it will have to pay the price for taking too long to negotiate a peace deal. We'll give you the details on that next. This is Bloomberg Open Interest. President Trump warning Iran it will pay a price for taking too long to negotiate a peace deal. The threat follows a fresh round of attacks from both sides over the past 24 hours. Bloomberg Washington correspondent Tyler Kendall is at the White House with the latest. So, Tyler, what do we know about the dangers of a collapse in this ceasefire?
Well, Matt, at this point, it's unclear if President Trump's remarks do mean that we are going to see the U.S. escalate in this conflict after we saw the two sides exchange strikes just overnight in response to an American military helicopter being shot down. CENTCOM did confirm this morning that the U.S. acted in what it said was a self-defensive posture and a proportionate manner, hitting Iranian military targets near the Strait of Hormuz. And we saw Iran also respond to that response overnight, hitting at least targeting at least 4 American military targets, according to Iranian state media. At this point, though, we do know that this White House has maintained that they want to pursue diplomacy and that is going to be a priority. But we also heard from President Trump in this interview that aired over the weekend that one of his red lines for ending the ceasefire could be if he feels that a deal is unable to be reached. Our own analysts at Bloomberg Economics have said that this flare-up in the fighting and the rhetoric could be escalation and a bid to de-escalate the situation. But Matt, I will point out within the last hour, we did get an update from Iranian state media that apparently a Qatari delegation has arrived in Tehran in a bid to try to keep these negotiations on track.
Does the president face less pressure as well to make a deal? Now we've seen oil come back down to $90 a barrel. We've seen gas come down, the national average, to $4.15 a gallon.
Well, we do know that there had been that political pressure, and that will still probably remain, as we know that it is a top concern for voters as we head into the midterm elections. President Trump has previously said that he is urging patience and that he's trying to negotiate the best deal possible. At this point, we're going to have to wait and see where these negotiations actually end up. There was some reporting yesterday by the New York Times that appeared to put some finer points around some of the issues related to Iran's nuclear program. Interestingly enough, because our understanding has been that the two sides are working towards this 60-day memorandum of understanding that needs to prioritize the Strait of Hormuz before we even get any sort of details on what curbs could look like for the nuclear program, but the Times had reported that there are discussions about a lengthy moratorium on uranium enrichment, potentially up to 15 years. Matt, no doubt President Trump has been feeling that political pressure at this point when it comes to energy prices. We're going to have to wait to see if that actually changes his calculation and if we are headed towards some sort of kinetic action here, which of course would impact those further.
Tyler, I have to ask you about the primaries, and to me the most interesting is Graham Platner. He won more than 70% of the vote in his primary, although he was kind of running unopposed. Is that seen as a success for the Democrat from Maine?
Well, so he was running basically unopposed, but he did win this big swath of the Democratic vote. But we should say that some of the opponents, including one who pulled out of the race, Janet Mills, won more than expected. And that is going to be the troubling signs, that margin that Democrats are looking for. There is so much attention on this race because Democrats really saw it as one of their best chances to flip a seat. Republican incumbent Senator Susan Collins is the only Republican senator who is running for re-election in a state that Democrats clinched in 2024. But the polling and the returns from Tuesday's primary do show us that Graham Platner still has a lot of room to make up with voters, even if they put aside his controversy, at least for now.
Yeah, he has or had an SS tattoo, as well as the sexting scandal post-marriage. Tyler, thanks so much for joining us. Washington correspondent Tyler Kendall there with the latest from Washington, D.C.